Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. There's a lot to cover here, so stick with me. Mortgage rates have fallen quite a bit since hitting a long-term peak in late October. By the middle of this week, the average 30-year fix was more than 1.25% lower from the highs and at the best levels in more than 4 months. Rates have fallen due to improvement in the bond market, but bonds aren't the only things that have an impact. In addition to the costs driven by the bond markets, regulators impose certain fees based on loan characteristics, and they announced a big change to those fees on Thursday. So, exactly which fees am I talking about? I'm talking about loan level price adjustments imposed by Fannie Mae and Freddie Mac, the two entities that guarantee the vast majority of new mortgages. Loan level pricing adjustments are based on loan features such as your credit score, the loan to value, occupancy and owner occupancy versus an investment properties, and now, after this week's announcement, your debt to income ratio. This applies to any loan guaranteed by Fannie Mae or Freddie Mac, regardless of the lender. This is a big announcement because most loans are guaranteed by Fannie Mae and Freddie Mac. Examples of loans that wouldn't be affected would be FHA or VA, as well as certain jumbo and specialty products. Non-conforming loans are not impacted by this as they are not guaranteed by Fannie Mae or Freddie Mac. A common example of a non-conforming loan would be a jumbo loan from a retail bank or credit union, or a bank statement loan, or really any loan that doesn't conform to the underwriting standards of Fannie Mae and Freddie Mac. Hence the term non-conforming. This will apply to loans that are guaranteed by the agencies starting May 1st, 2023. That means many lenders will begin to implement the changes in March or April. So what changed in a nutshell? While you still get the best terms with the highest credit score, the effective penalty of having a credit score under 680 is now smaller than it was. For instance, if you have a score of 659 and you're borrowing 75% of the home's value, you'll pay a fee equal to 1.5% of the loan balance, whereas you'd pay no fee if you had a 780 plus credit score. But before these changes, you would have paid a whopping 2.75% fee with that same 659 credit score. On a hypothetical scenario, a hypothetical loan, that's a difference of $3,750 in closing costs. The following table shows loan level pricing adjustments in terms of percentages of the loan balance. The top row is the loan to value ratio, and the column on the left is credit score. For instance, a FICO of 740 to 759 with a 75 to 80% loan to value would have a loan level pricing adjustment of 0.875% or $875 for every $100,000 borrowed. The same loan amount on the same property would have a loan level pricing adjustment of 2.75% or $2,750 for every $100,000 if your FICO was 639 or less. For those of you wondering why higher LTVs begin to cost less after 85%, part of the reason is the implied presence of mortgage insurance. The higher the LTV, the higher the amount of mortgage insurance coverage required. The other reason is that Fannie and Freddie's congressional mandate involves fostering affordable housing and promoting homeownership. Their regulator, FHFA, said in a statement that these LLPA changes, and I quote, maintain support for single-family purchase borrowers limited by wealth or income, end quote. In other words, if you can't afford a big down payment, FHFA is cutting you a break. The notion is even more apparent when we examine how the LLPA grid changed from the previous version. The biggest improvements in costs were seen in credit scores of 679 and lower. These improvements were, quote, paid for by making things more expensive elsewhere on the grid. Hashtag transfer of wealth. Borrowers with higher credit scores will generally be paying a bit more than they were under the previous structure. The following chart shows the differences. Green cells show where things have become more affordable than they were. Red cells equal more expensive. All values refer to a percentage of the loan balance charged as an upfront fee. This doesn't necessarily come out of your pocket as an upfront fee, as lenders can offer higher interest rates in some cases and pay these costs for you, but the costs are still there and still technically being paid by you over time in the form of a higher interest rate. There are many other changes that aren't so easily translated to a heat map table. The most notable is the new charge for debt to income. And that's a big one, debt to income ratio. This will be controversial in many scenarios, as income calculations can be somewhat subjective and debt calculations can be legitimately tweaked with some advanced planning and or debt consolidation. Nonetheless, every loan guaranteed by the agencies has a debt to income ratio attached to it. If yours is over 40% and you're borrowing more than 60% of your home's value, you'll be paying more. Here are a few other examples of changes. So who decided these changes should happen? The FHFA, of course, and to think that everyone was mad at Mark Calabria, the former head of the FHFA, but was let go in June of 2021. Now, shifting gears to this week's economic data and market movement. I received several monthly housing-related reports, several of which suggested the negative momentum may be ebbing or even reversing. The National Association of Home Builders posted builder confidence numbers that were 4 points higher than expected and 4 points up from last month. The Mortgage Bankers Association reported a big increase in both purchase and refinance applications relative to last week's numbers. The Commerce Department tallied fewer housing starts this month, but the number beat the median forecast. Last but not least, the National Association of Realtors reported that existing home sales remained above an annual pace of 4 million units, slightly higher than the 3.96 million expected by analysts. The bond market put in a mixed performance with improvement on Wednesday, resulting in the lowest rates in 4 months. Thursday was fairly flat, and Friday saw some deterioration. By the end of the week, trading levels were almost perfectly in line with those seen at the end of the previous week. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.